Hi guys, I'm Phil Town from Rule 1 Investing, and today I want to talk to you about something very controversial, timing the stock market. Being able to time the stock market, which means predicting when it's going to crash and then invest accordingly, is like nirvana, the holy grail of investing, to have the crystal ball that says, the market's going to crash. I'll tell you, no matter what some analysts might tell you, timing the market in this fashion is impossible. It ain't going to happen. Nobody has the crystal ball. However, instead of predicting a crash, right, there are different ways to kind of time the market that even investors like Warren Buffett and Charlie Munger do, and these are entirely doable, and they can end up being just as valuable. Now, the perception of timing the stock market is often misconstrued. Many investors think about timing the market to be predicting when a crash is going to take place and selling before it does. You are going to hear me on CNBC in the past, both in 2007, 2009. I'm telling you, I've been on there and I've been saying, hey, I'm out, right? I'm out, and I'm going to stay out until this market is cheap. And that looks like timing the market, right? But the thing is, stock market crashes are impossible. I mean, nobody can predict them, even the most informed investors. When I started getting out of the market in 2007, I was way early. The market went up another 10% before it started to go down. So instead of trying to time the market by selling before a crash and guessing about what's going on out there, it's a lot more beneficial to time the market by buying after a crash. That can be very, very good. Those stock market crashes present an excellent opportunity to buy really, really valuable companies at super discounted prices. After the market comes down, this is one of the best times to buy companies that you have targeted as great investments. They're on your watch list. You've been working on them for a couple years. You really know them, and you know what they're worth, and you know the price point that leaves plenty of room for you to have big returns and a big margin of safety. Timing the market in that manner, that's very Rule 1. Very Warren Buffett, very Charlie Munger, very Phil Town. Timing the market like that, predicting that you'll have gains after a crash rather than predicting the crash itself, that's the most effective way to time the market. Of course, you're going to need to invest in companies that are going to survive a big meltdown in the economy, right? Not all companies can. In fact, when we have a recession every 7 to 10 years, we like to say that, you get to see who's swimming naked when the tide goes out. That's when the weak companies fail and get acquired or go bankrupt. Following a crash, you're going to always want to choose established companies that have a moat, something that keeps the competitors from carving away a large portion of their market share. You want companies that are going to be the carvers, not the carvees. You're going to also want to be sure and buy companies you believe in, companies that match your values, that align with what you want to see in the world in 20 years. Companies like that, you're just going to automatically want to dig in deeper. If you want to know more about that, read Invested. My daughter Danielle, digging into companies because she really loved their values was what got her really excited about investing. So like most great investors, Warren Buffett does time the market. He does time the market. Now here's how he does it. It's really simple, you guys. It's really obvious. As a Rule 1 investor, Buffett wants to buy companies at a margin of safety, right? He wants to not buy them for what they're worth. He wants to buy them super cheap. He wants to buy them for about half of what they're worth. And what that means is an automatic kind of timing the market. Right now, Warren has about $120 billion in cash. Right now. With the market as high as it's ever been, he's sitting in cash. Is he timing the market? No. What he's doing is looking hard to find something to put $120 billion in cash into that he can buy on sale. But because the market has been going up for 10 years, there's nothing out there that's available to buy on sale. So what looks like timing the market is really just a Rule 1 investor going more and more in cash as it's harder and harder to find things that are a deal. Really simple. You're automatically pulled in the cash by having everything get too expensive. So you're sitting there in cash when the market crashes. That's inevitably what happens. And after a crash, here you have all this gigantic wheelbarrow available of money to go out and buy all those great companies that are on sale. Buffett says that the priority is to find cheap individual companies with solid fundamentals rather than investing in the whole market. So timing the market based on the value of individual companies rather than the overall direction of the market is how you end up in cash before the whole thing goes down like a brick. So it's a wonderful structure. It looks like timing the market, but it really isn't. Timing individual companies allows you to take advantage of discounts on companies that will, in all likelihood, only be affected by a crash for a short period of time. In other words, once the effects of the crash wear off, right? Once the recession impact kind of stops, great companies are still going to be going strong. And in most prices, this is awesome, their price will return to its pre-crash level in a matter of months, or certainly within a year or two, and they're going to go out and acquire more market share or even acquire their competitors who were not so strong. Buffett also warns not to sell during small crashes, right? Instead, weather the storm by focusing on the long term. We sell when the price of the company gets to its true value. That's when we sell. We don't sell just because it goes down a little bit. We use the market going down as an opportunity to buy more if this company's still on sale. If the companies you own are successful, established, wonderful, big moat companies, they are likely to return to their pre-crash price before long, especially before the rest of the market, making holding them the wisest decision. So if you've got a company that is on sale right now, you buy it right now, you want the market to crash and send that thing tumbling down 50% so you can buy more. I wrote a whole book about it called, Payback Time. Go read it. Trying to play a guessing game about when to sell before the crash, that's almost always going to lead to a headache and a lost opportunity. We sell when value and price get to be the same. We buy when price is far below value. Timing the market by buying stocks after a crash is great for knowing when to buy a stock. All right, so let's talk a little more detail about when you're going to sell it, right? I'm just telling you right now, the most long-term investors are going to sell stocks eventually if they want to lock in their returns, even when we say the best time to sell it is never. So while it's best to buy stocks with the intention of holding on to them forever, there are a few times when you're better off selling. As I was saying, when greed, the emotion, the predominant emotion in the market is this is where you gotta go, which is where we're at right now, driving the price of a stock up above its true value, that's when we nimble little investors can sell. In the same way that undervalued stocks are almost always eventually will go back to their true value, overvalued stocks almost always come back to their true value as well. So it's important to keep in mind, though, the difference between price and value. This is the edge we have as Rule 1 investors. The price of the stock can fluctuate all over the place, but its value is typically inherent to the company based on its long-term probabilities in the market based on that great moat and solid management. And that won't change much unless a major change in the company itself takes place. So if there's no major change to the story of a company, what we are investing in, and the price is still at or below its value, hold on to it as long as you can, no matter what the market does. If this is a great business, it just works out better to sit on it. So throughout all of this, it's important to keep in mind that when determining whether to sell a stock, you are evaluating and timing an individual company based on its value and its price rather than looking at the overall market, because nobody can predict with certainty the future of the market. But the right investment know-how, understanding value and price, you can predict the future of an individual company in the long run, and that'll allow you to know when it's time to sell. Pretty cool, huh? Now, I'd love to hear from you guys. Have you ever tried to time the market? Did you try to use some kind of market timing tools? Did it work out, or did you get smoked? Leave an answer below, and I'll be sure to follow up with you guys. Thanks for watching. Now go play. Guys, if you enjoyed this video and you thought it was valuable in teaching you more about trying to time the market, hit the like button and please share this video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click the button on the screen for a free gift. So thanks again for watching.